Hello and welcome to Moving Iron Podcast number 299. This edition of the Moving Iron Podcast is brought to you by Axon Tire, helping dealers move more iron for the past 100 years. For more information, go to axontire.com. The Axon Tire, good folks over at Axon Tire, I'd like to give all the loyal listeners a free pair of deerskin work gloves. If you want to get those work gloves, send an email to marketing@axontire.com and they will be sure to send that over to you. Just make sure you tell them that's Moving Iron Podcast sent you, and that's marketing@axontire.com. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. At Valley Transportation, our goal is to help you reach yours. No matter how you buy your ag equipment, whether it's from a dealer, an auction, or a private party, AgDirect can help you finance it. You can even apply online at agdirect.com. Learn more about your financing options at agdirect.com. Tractor Zoom has access to over $20 billion in heavy equipment sales. Tractor Zoom's Iron Comps is the industry's trusted solution for transparent equipment values and auctionable pricing insights. This podcast is brought to you by Anvil AppWorks. Their Dealer Connect CRMI app with their integrated inventory management is an affordable Salesforce-based solution for your dealership. Create a connected customer experience and transform how you work today. I have Rich Posson with me here, and he is kind enough to come on and talk about once a month about what's going on in the marketplace and the economy. And Rich, I tell you what, there has been a lot of stuff going on since we talked last.
Yes, indeed. It's been very busy on the data and the news cycle and everything else.
Yeah, very much so. Obviously, interest rates are something that's high on people's mind right now. Not last week, but the week before, the CPI report came out and showed that inflation was creeping up there at about 8.1% for the year. You keep kind of watching these things move around, these moving parts happen. I think the one thing I want to start with first, Rich, is because it's always been such a leading indicator of where the markets or where the economy is heading as a whole, and that's gold. You take a look at what gold's been doing over the last couple of weeks here. It's not been responding the way you think it would be. The last CPI report came out, showed inflation was going up, and the price of gold has hit a low here, an 8-year low or something like that. I guess so. Rich, as you're looking at that gold, why is it not responding in a different fashion than what it is?
Yeah, I think some of it might be the interest rate side of thing, that they're raising interest rates fast enough to kind of keep up with inflation. And it takes away from their point of view in terms of how to make money out of gold. If we had kept interest rates lower than this, in other words, I think you would have seen a higher gold price. I think the gold market's been telling us for more than a year now that it is very feasible to beat inflation through rising interest rates. And it's just not that setup of the like the 1970s where you could just buy gold and set on it, and 10 years later you made a fortune out of the thing. The market has recognized it's a little bit different story this time around. We got high inflation, but there's internal things just aren't like what we've seen in the 1970s. I also think on the hedge side, for people in the stock market, Wall Street, whatever, they learn to invest in other commodities than gold. And then, of course, there was for a while there the Bitcoin thing, the cryptocurrency as a hedge too. That's been blown out of the water, and nobody's talking about that anymore. But it's interesting, even though they got blown out of the water, they didn't flip back to gold and saying, well, I got to buy gold to hedge. I need something to hedge. They really haven't been doing it. And it is interesting. My modeling over a year ago said we got to start preparing for a bear market and gold. And I was just watching last year's low. I had a double bottom there, and I just said, if it takes that out, we're on our way. Well, this year it took it out. And as of this morning, it just moved to a new low for the year. It's down $9 in gold right now, or at least on the futures. And I think I am bearish into mid-decade for gold. And I think eventually a lot of these commodities are going to be bearish into about mid-decade to a little bit later. The question is, when do they all top? And I think some have topped, some haven't. Over in the grain sector, we can get some weather issues here next year and the following year for a cyclical crop problem that could create another uprun, I suppose. But when I look out to mid-late decade, I think all the agricultures and metals will be down here. This will help reduce inflation a bit, but for the producer, it might shake them up a bit. The prices come down faster than their input cost. So I'm not an optimist when I look out into mid-decade for commodities or even real estate. But I think, and I think gold is just going to work lower. Now, when I say that, I think gold's worth like $1,400, okay, but it doesn't have to show up for a few years yet. We can have $50 to $100 upswings in gold along the way. It's not going to be an easy bear market, I don't think. And it looks like to me the gold producers kind of on the same page. They're willing to hedge gold, and they're still willing to crank out all they can to produce gold there. So big disconnect for gold. It's almost like gold kind of forecast this inflation, but back in 2018 to 2019, and then said, "There, I've dialed that in. It's over and done with." And I suppose if 2 years from now we're back at 7 or 8% inflation again, I wouldn't be surprised that would shake up gold and be more bullish than I think. But I don't think that's how it's going to work. So,
okay. So other thing I was going to talk to you about on this kind of the gold front too was also on the real estate front. If you're looking at where we're at right now with interest rates over there at, there's a lot of people that would be selling a home and had maybe 0.9% interest, 1.2% interest, something like that, 3% interest, and they're going to the bank now and getting some 6+% interest rates on their home. With you working in real estate like you have been, Rich, have you noticed any kind of a slowdown there, or are you seeing more inventory in the market now than you've seen in the past?
Not so sure seeing a surge in inventory. It's picking up some where people are getting nervous. They've kind of are missing out here. They recognize the higher interest rates. They're hearing on the nightly news that some of these real estate numbers are coming down hard and fast here now. The home building sector, some of the polling of home builders is pretty pessimistic right now. I mean, the interest rates rallied enough that it's more than doubled your cost to go out and borrow for a home. But at the same time, I don't see this panic to sell. It's more of a worry that maybe they got to lower their price, but the demand side is definitely backed off in houses. I try to work a little more land than homes, and I'm seeing pretty good solid demand for land. I'm seeing some people probably pulling money out of the stock market and trying to buy some land for a hard asset, place to go for the next disaster to hide out on. and
Right.
it's that kind of mentality, and the land prices didn't shoot up anywhere near as fast as the home price. And then you got homes that doubled or more, and land here in New York, land prices on average go up 4.5% a year. Yeah, we're seeing some land up 20 or 30%. We're also seeing some land that's really just gone up a minor amount. So I think the demand for land is going to hang in there for us. But as far as the homes, I want to say it's over and done with, but I'm not hearing worries from realtors. They're just kind of acknowledging it. I mean, I did have a friend whose wife's in real estate, and he said, for the last year, I didn't even see my wife. She was that busy in the real estate. She just went, go. So this last 30 days, she hasn't even left the house. No appointments. And 3 weeks ago, I was kind of shocked. All of a sudden, it's just like, boy, the phone's not ringing, the emails aren't coming in, people aren't searching a website. What the heck's going on? However, the last 2 weeks, we've been running, we've been busy. But I do think it's over for the home explosion there, and I just see that deteriorating right into mid-decade. So,
Gotcha. All right. One more thing that we're seeing a lot in price, and we've seen the price of fuels come down, whether it's from where they were a year ago. They're still really high right now, but they're looking at where they're at. Looking at energy, Rich, I mean, we've got a lot of moving parts what's going on in Europe and Russia, and getting natural gas to where it needs to go, and all these different things, and how we're getting natural gas around the world because of the Ukraine-Russian war. I guess looking at energy right now, Rich, what are some of the things you're watching? What's some of the things you're paying attention to, and some of the stuff that your models are saying about the price of fuels?
yeah, I think you'll anytime now into February, you'll probably see the gasoline market bottom and do its seasonal rally into summer driving season. Wouldn't be a bit surprised the highest price, however, at least for futures, will be over and done with by Memorial Day. That's kind of a little seasonal study I work with. But heating oil, you would think, okay, we're going into winter. That's going to be buoyant here. And yeah, I can see that. But I focus more on the crude oil just because I tie it into my stock market and economy and everything. And yeah, I see that buoyant by summer, but I'm not seeing an explosive up move. I just don't think it's got it, but I can be wrong. You can see with the politics and geopolitics, you can see that these oil companies are really holding off on purpose of drilling. I mean, we hear all the political stories. Oh, we got to allow the oil companies to have more permits and more permits. They're just doing that to try to get the permits and put them in their little cookie jar. They have enough permits to drill more oil, and the profits are huge, so they can write huge checks to these drillers and put these drillers to work. And it has increased, but it could have increased much more than this. So you can see they're holding back on purpose. I just saw a study, a beautiful chart put out by someone showing diesel fuel. If you look at the profit margin for those refiners, it's 450% of the average profit margin since 2000. It's just gigantic. I mean, they're just raking in the dollars. They are holding off on production more than we would like as consumers. At the same time, they have things to back them up on that. They have issues where the supply isn't quite there the way it used to be and things like that. And they can, cite that they got all this geopolitical risk around the world and this and that. So they've come up with these reasons, but the point is they're kind of abusing those reasons and abusing us as consumers. So, and this will pass. This will correct. But I must say it's holding up stronger and better than I thought. There's some things that have changed here in corporate America on the manufacturing and production of things that I just wonder in the next few years we may learn. A lot of these companies don't. They're just careful. I'm not trying to overproduce, and it does have something to do with the psychology and what we've experienced here with this virus pandemic, the lockdown, the money printing. And so my conclusion is, yeah, we're probably going to pay more at the pump come summer. I think hopefully there's a little more downside first here. And I will say with Saudi Arabia backing off on us, helping us out here, the oil market really didn't respond that well. Now, of course, then Biden come out saying, well, he'll just pump more money oil out of the reserve. And he did do a correct free market kind of attitude of saying, well, we'll refill the reserve if oil comes down to $70. So that kind of tells the oil companies, we will provide a floor price for you. So get out there and produce. But I'm not too sure the oil company cares that much about it. So they're going to drill if they want to drill. And the sad thing is, I realize some people say, well, we shouldn't be interfering with the free market trying to actually drive energy prices down. And I'm a free marketer, but I've learned over 40 some years, there's some things in free markets that aren't right, and we don't acknowledge it and admit to it. And I'm in favor, if your country's going in a crisis, it's okay to play games and mess with the free market. And we should be bringing these prices down. And the thing is, inside these big businesses, they love to do what's called stock buybacks. Now, granted, this is for companies that are in the stock market. I'm not talking the private equity companies that are privately owned, but they may be of the same mentality. But in the stock market, you'll get these corporate executives who say, boy, we just made a boatload of money. Instead of expanding the business, expanding production, why do that? Why not? We're comfortable here. We don't need to get any bigger. Let's keep the margins up. But what do we do with all this money? Well, they do speculate in stocks, other companies, they invested here and there paper wise, but they also do stock buybacks. And stock buybacks help support the stock. And so in theory, they're helping investors. Bottom line is they're helping their portion of the stock market. So it's a way of converting corporate profits right into the wallet of these corporate managers and business owners. And the government's looking into that. They've been talking of raising taxes on that kind of stuff, because a lot of people are saying the stock market probably wouldn't even be anywhere near this high, because this has been going on for 10 years now, that these buybacks are so huge, it can drive the stock market up even when the fundamentals and economy says it shouldn't go that high. So that's another little thorn in all the machine here, or however you want to look at it. So a complication here. And I guess what I'm trying to get at least on the energy sector, that supports their thinking. Yeah, just put the money in our pocket and don't go out there and drill. And you and I are then stuck hostage, And let's flip over to inflation. As I said, I don't think we're in the 1970s inflation where we have 7.5% year after year after year after year, and prices just double in a matter of a few years. I think we're going to see it set back. Yes, we've seen more than 7.5 like we saw in the 1970s. We've seen 8.5 or more, but I think it was just one surge and it's going to back off. But I've also said, I don't think it's immediately going to drop to 2% like the Fed wants. I wonder if we're even going to see 2% for years to come. I think for the decade, the average is like 3%. Well, why is that? Well, I think it's the mentality of these corporations have changed to make sure they just don't shoot themselves in the foot, overproduce, don't sell too cheap, keep a safety net. And this whole virus pandemic lockdown just taught everybody, hey, you got a different kind of risk you got to deal with. Be careful of how you're producing. And to me, and then that also, the same thing for laborers. They've learned I need a little extra buck here once in a while, because of this risk I just learned about of things that can just blow up on us. So the whole mentality is changing for the entire population here, and I think it's going to keep inflation up. And the beauty, and on one hand, I'm glad to see this because for 10 years now, I've said we're due for a super cycle bottom inflation. We're going to see inflation rise for 2, 3, 4 decades. But I've also said I just don't see like the 1970s. I just don't see years on years of very high inflation. But I think we're going to see somewhat, and I think we're getting a taste of that, of how these corporations are managing themselves, as well as the return of unions and people wanting the mentality's changed. Whatever we did for 40 years, we told ourselves it's okay not to get a pay raise as long as we're producing more and more. We'll make more out of our retirement account or stock investment. We'll get more bonuses. Okay. Now people woke up that they really didn't get their fair share. They should have been getting more pay raises. And so, yeah, that whole 40-year trend of lower interest rates, lower inflation's over. But I don't want to scare people like some people are. I just don't see explosive inflation. And even if we get it, the Fed has sent a message. They have to. They'll take interest rates 50% or some crazy thing if they have to, is what they're telling us. So they will kill it. And that's another reason the gold market really isn't doing much. They're thinking, you know what? Things are a little different than other years of inflation here. We can kill this. We'll kill our economy. We'll kill our economy. And even yesterday, one of the Federal Reserve guys came out and just said, hey, we're really not seeing any evidence for doing anything on this inflation. We may have to take these interest rates much higher. So, but we'll see.
Yeah. Before we started recording, you and I were kind of talking, kicking around a couple ideas here for the show. And I brought up the fact that, you take a look at a lot of these companies, these manufacturing companies, Ford, GM, Deere's, Case IH, or CNH, I'm sorry, like AGCO, a bunch of these different companies like that, where their stock prices are high and they've done really well through the pandemic and the way it looks. You kind of alluded to that a little bit in your previous statement there, but I guess, Rich, when you look at some of this stuff, do you feel like this is the new norm? That this is going to be we're going to produce what we need to produce. We're gonna keep things. I don't want to say elevated; it's not the right word, but we kind of figured out a different business model coming out of COVID, and how things are going to work, and relying on just in time. Manufacturing is not something that we can totally, completely rely on if something crazy like this happens, like we see with COVID. Do you feel like this might be the new norm? That hey, we're only gonna produce X, and that's it. We're not gonna try to do any more or any less than this number right here.
Increasingly, I'm heading in that direction. I don't want to, because I can see some of the negative things out of that, right? But I think that's probably correct. That's where we're headed, and I can see this for industries, like John Deere. They're not going to produce as many combines as the auto industry can produce cars. It's always going to be a much bigger bit. So to me, if I'm John Deere, and let's face it, John Deere knows more about finding data than anybody else in the entire ag industry. And this is just my opinion, observation for a few decades, but I think they can get a better handle on saying we're only going to sell X amount of combines. That's all there is to it. That's it. So let's make sure we don't expand business when we just produce too much and put us in a problem. If we need to expand business, we need to go find another product, something else we can create. And I think today the data is just so overwhelming here, so much of it, that these companies have a better idea today how to match that demand than ever. It doesn't mean they will. If you look in even recent years, you'd say, well, yeah, they may have known it, but they didn't really do it. Well, I think, again, I think this virus pandemic, this lockdown, the supply chain crunch, I think it's taught them to take more seriously their data and more seriously their concept of, hey, let's put this free market economics to work for us in the sense of, just don't overproduce like we've done in the past. So, yeah, I think it probably is here. I wish I had a more detailed story for you. I think this is a story that's being written and
Right.
and a bit different from what we're experiencing in our lifetime here. So,
Yep. And I will say this: pre-COVID, 2017, 2018, 2019, you were seeing inventory levels kind of hit the max on. It didn't matter if you were talking about cars and trucks, farm equipment, over the road semi, whatever it was that you were talking about. Used inventory levels were high. I remember reading a lot of articles about used cars and how so many cars had been leased and they were coming back in. There's going to be a big wave of cars come back in from lease buybacks and those kind of things. That there's going to be a huge problem. Well, we hit the COVID issue, and now that stuff's kind of cleared itself out. We're kind of back to an empty cupboard again, and I'm kind of with you, Rich. I think some of these manufacturers are stepping back and taking a look at why would we ever do that again to where we're at now. Plus, with the buying public, we're looking at people that have very defined areas that they're going to stay in. And not a lot of people are going to be jumping from a car that they've been driving forever. That's a $25,000 car, and somehow they're going to jump up to a $75,000 car. We're not going to see that like we've seen in the past, where people, because the dollars have gotten so big that people are kind of in a box, and those consumers are going to be operating within that box because that's where they can operate at, and no matter what kind of creative financing or whatever programs come up, they're still going to have to operate in that box. And I'm kind of with you. It kind of feels like this is a new normal where we're going to continue down this path of producing what we need to produce to hit the numbers that, as much as I hate to say this, Wall Street wants us to hit, and we're going to maintain that profitability level and that stock price where we need at. So I don't know, there's some negatives to that, just like you said, but it just feels like everything's going down that path.
Yeah. There's a pro and con to it, but we're going to do it one way or the other, I think.
Yeah, that's very true. Very true. All right, let's jump over to talk about this. You've watched the economies around the world and what we see happening there. You've got it's really hard to believe what you hear coming out of China, because typically it's not right. But when you look at the stuff they have going on there with their inflation that they're seeing inside their country, plus you look at a big real estate bubble that's going to pop there, very similar to what we saw here in 2008. And Xi came out and had a nice fiery speech about how he's going to bring back everything to mainland China, that mainland China's and basically the Pacific area is our backyard. We're going to treat it like it's our backyard. You see the tensions of Taiwan, you see what's going on with Russia and Ukraine. And as you look at that kind of stuff from an economic perspective, there's some big issues in Asia, and obviously Russia and Ukraine as adding on to that. I guess as you're looking at those economic factors over there, how much do you think that's going to affect what's going on in the world, and how's that going to further affect the United States?
Yeah, so in China, obviously they're still fighting COVID and they're still willing to do lockdowns when the rest of the world kind of backed off on that. And I kind of get it. For their population, they're scared to death it could really turn into a disaster. But at the same time, it's hurting their economy too. And then of course they got the real estate blow up. And then of course we have this whole Cold War, trade war type development that's been going on here for a few years. Where nations are trying to figure out how do they take care of themselves and produce more of themselves and buy more internally. And China has recognized this. They're trying to shift gears of how do they build their own consumerism and keep their own manufacturing. But like you said, they're also looking at a region of what they want to carve out. And this is going to create some tensions for decades to come, I think. that we can get some wars and we can get some additional trade wars and complications here. Right today, I don't see anything is ready to blow up. And people ask me all the time, well, on the stock market, what if a nuclear bomb goes off in Russia, Ukraine? What if this or that? Some of these things are just too difficult to predict, and you just have to do the best you can of staying with what is the actual economy in your country and what is your business doing. And right at the moment, I don't see issues in the next 2 years that the world's going to blow up somehow and economies are just going to be horrible and the stock market's going to crash and burn. I can't rule it out. I mean, I'm old enough, smart enough to know that you can't predict everything. You just got to always look for it and always work at it. But the best probability is we're probably still going to be all right in the next couple of years, have a good stock market, and get this economy back to somewhat of a normal. It's going to be a different normal, just as we just discussed here, what's going on in manufacturing. It's going to be a different normal. And but it will be somewhat normal in the sense the stock market will still figure out how to make a buck out of it and move higher, and the economy will hang in there, and we'll ease the inflation back here a little bit. But I do have beauty of this modeling is it can show some of the important times during a decade when you may run into issues. And for my subscribers, at least, we'll be showing those periods of time when we do want to wonder, is something going to blow up in China that creates a contagion that hurts us? Whereas right at the moment, a lot of the China stuff is kind of contained for China. It may be impacting nearby countries a little bit through their trade, but it's not really impacting us in terms of our economy and our stock market. It is impacting with the strong dollar and the internal issues of China that we're not getting our grain exports the way we'd like. And we have to keep that. So when you get into microeconomics, you can argue that there is a bigger story there and it's making an impact. But on the macroeconomic side, I think our economy is trying to go along on its own right now and shrug off this geopolitical stuff. But well, you can see where a lot of fires can show up around the world, and our strong dollar, it can actually hurt the global economy. We've been taught in textbooks, well, the strong dollar ought to actually help those other countries. They can boost their exports, they can do business, but I'm sorry, I'm one of the few that says no, that's not how it works. So basically, we're hurting the global economy with higher interest rates, fighting inflation, and it's not just us. There's central banks around the world doing the same thing, but our dollar is actually causing some global issues here, and our Federal Reserve is hurting the global economy as well as they try to correct us and correct our economy and correct the inflation story. So.
Yeah, that's the strong dollar when you're looking at, especially this time of the year where you're going from our key exporting time frame between November, December, February, March time frame. We see a lot of U.S. Exports leave. That strong is throwing some wrinkles in there. So interesting times to watch, man. So Rich, I appreciate you being on the podcast. If folks want to reach out to you, get more information about what it is you're doing, talk about your podcast a little bit, where's the best way to find all that information?
Go to criticalpointpod.com, and that's a website where I explain a bit about myself and the service, and you'll find a link there. It'll take you over to the video, audio podcast page, and you can sign up there. There's also a sign-up page right on the homepage, but it'll give you some information there. And then you can go to my Twitter account at Rich_Posson, Posson. And yeah, you can ping me either or message me through Twitter there. And you can also reach me at rich@ag-financial.com. And I offer subscription service on the economy, stock market, a little bit over in the interest rates and gold market and energy. I like to follow the three major grains, corn, wheat, soybeans, and do a little climate research looking for some crop problems. And I'm primarily based on business cycles, which I think does a better job of at least telling us what's going on with the demand side of things for our economy and some of these markets. And basically, I got a near-term forecast of still higher interest rates here in the next few weeks. And I think that's going to cause some problems for the stock market still. But I'm an optimist next year. So take it from there.
You've talked about that a little bit. When do you see that? You've talked about January, February, that first quarter time frame of kind of seeing the high point of interest rates. Are you still in that camp?
Yeah, yes, I'd like to see the free market peak out sooner than that. Now I'm not so sure, but just depends how quickly they'll bring this inflation down. If we get a 7.8% headline CPI, not the core, I think we're on our way lower, but obviously lower than that would be much better evidence. There are some pretty smart people out there thinking 6.8% by December. That'd be a nice drop. That would really change the attitude of the stock market. I'm not convinced it's coming that fast now. I've been wrong all summer thinking it's just going to crash at any moment, and it just doesn't do it. So I'm kind of now saying, okay, I'd rather be a little off the mark in the sense of let's take it slowly here and just assume it's not coming down as fast as we'd like. I am in agreement with some of the smarter minds out there that do see a sizable drop next year in inflation. I think we will get it. But it's interesting. Someone said they see it maybe 6.8 in December, but by next September next year, 3.2 or something like that. So there again, that's that story how difficult it'll be to get it down to 2%. But I think it's going to be if once the stock market wakes up to the fact it looks like there is a downtrend. I think instead of them hoping for a crash, they're just going to say as long as it moves slowly lower, good enough, and they're just going to buy those stocks. So I think you'll see the stock market rally as the inflation comes down. So you can't wait for the inflation to come down a huge amount and then say buy the stock market. It's going to bottom ahead of this whole inflation story. It's going to bottom ahead of a lot of these economic indicators. It's going to bottom ahead of a lot of the consumers waking up because consumers are far more negative than what they're actually doing in their retirement accounts for their stock market. They too learn that you might better hang on your stocks even if you think the end of the world's coming, because it's just crazy how the stock market eventually goes up again. So it is a process, and the stock market is probably going to bottom sooner. And I'm going to throw some darts here, anywhere into next February or something like that. Try to find another long-term bottom. And but my gut feeling, and I'm disappointing some of my friendly competitors, they're bulled up on the stock market in the sense seasonally the stock market is up well in November and December, and it's normally poor September, October. So they're looking for a turnaround, a bottom right now. And my model is saying might better wait into November and see on November 2nd what the Federal Reserve does, which they should raise 3/4 of a point yet again. But what's more important is what does Powell say right after the announcement of raising? What he says is going to be more important than the actual interest rate. So maybe we'll get something encouraging in November off the inflation report and off of this interest rate stuff. But I got a feeling, at the beginning of the week, I told my subscribers, hey, we got a buy signal. I think it was on Monday. I just said, we got a buy signal for interest rates, therefore a sell signal and bond prices. And I said, it's going to move to a new high for the year and it shouldn't take long. And I think if the Fed's going to raise 3/4 a point, that puts them at 4%. The 10-year Treasury note ought to go to at least, I think it should go to 4.5. And this morning we just touched 4.3. So it's working. I will say it's rather fascinating. The stock market hasn't collapsed on this news, though. It's only come down some. I also triggered a little short-term sell signal in the stock market, and I don't have much proof of being right yet. But we'll see what we get today, because the interest rates are running hot. And I think they're going to put them higher right into that November 2nd report. And I think this should give the stock market some more problems. I think it's going to push the dollar higher. We had a buy signal in the dollar, which the commodities, I don't know, for years I've said the dollar isn't as important to grains like everybody thinks. And I've worked in commercials and I learned that. But at the same time, this dollar is so high, it has to be important. And we're just seeing evidence. We're not getting any exports. China doesn't want to buy from us because they don't like us anymore, but they're also thinking, hey, these grains are high price. How much can they afford in their own economy, So, boy, we got a lot of issues. I mean, there's little fires all over the place. And even if the stock market bottoms now, there's going to be plenty of headwinds for a while, too, I think. But my near-term forecast is they're going to push these interest rates higher. Stock market ought to back off. And then we'll reevaluate from there. But yeah, I do think the overall process this year, and I will say the model was right. My personal investing, I didn't really keep up with the model the way I should have. I tried too many other little things there and could have benefited better. But in December last year, the model said it could be down all year, even though it was favoring an early bottom, and we picked those bottoms. The market rallied nicely, and the next thing you know, it just gave up on it. And it's just because this inflation will just not die, and therefore the interest rates just keep going higher. And we just got to respect that and follow it the best we can. But it does feel like we're going to burn through this whole process of trying to peak out inflation and interest rates by first quarter of next year. Is the latest I see, and I'm hopeful it comes a little sooner.
Right on. All right, let's give that podcast website out one more time.
Criticalpointpod.com.
Right on. And find him on Twitter at Rich_Posson and send him an email at rich@ag-financial.com, and you can get more information from Rich there. So, Rich, appreciate you being on the podcast, man. It's always a pleasure.
Thank you very much.
Right on. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Moving Iron Podcast on LinkedIn, and you can find this video version of this podcast on the Moving Iron Podcast YouTube channel. Go to Moving Iron LLC for everything Moving Iron related. I know it sounds like it's a long ways away, but it'll be here before you know it. Moving Iron Summit, Nashville, Tennessee is coming up September 11th through the 13th. Axon Tire has done something awesome where they're going to give the first 150 people a $50 discount on the registration fee when you use Axon during your registration there. So check that out. It's well worth your time to come. Rich was a speaker last year, and he had a lot of good information he gave out. So speakers like Rich will be there giving out information about what they see happen in the marketplace. So with that, I'm Casey Seymour with Rich Posson. Smooth Smart, folks. Out.
Moving iron in the 21st century.